What is happening, crypto champions? Get ready for a whirlwind update because the market never sleeps, and neither do we. We're diving headfirst into the most explosive stories that are shaking up the digital asset world right now. From unexpected family ventures into the crypto space to seasonal market shifts that have everyone talking, you're about to get the inside scoop on what truly matters. The pace of change is relentless, and if you're not plugged in, you're missing out. We've got the crucial details, the insider analysis, and the predictions that will keep you ahead of the curve. Don't just follow the market, understand it, anticipate it, and conquer it. This is your essential briefing, your competitive edge, your Bitcoin Bulletin. Let's get straight to it. First up, we're breaking down a fascinating move that sees a prominent family, the Trumps, making a significant play in the cryptocurrency arena. What does this mean for institutional exposure and the future of digital assets? We've got the analysis you need. Then, we're tackling the age-old question. Can Bitcoin overcome its notorious September slump? We'll compare its performance against gold's impressive resurgence, dissecting the data and the narratives that are driving these contrasting market movements. Is gold reclaiming its safe haven status, or is this just a temporary blip for BTC? Next, get ready for some serious supply-side drama. We're uncovering how institutional demand is absolutely overwhelming Bitcoin's creation rate, leading to critical supply concerns. What are the implications of this imbalance, and how is it being described by industry insiders? And finally, we're celebrating a monumental surge that's pushing Bitcoin past the $109,000 mark. What's fueling this incredible rally? We're looking at the powerful combination of scarcity, regulatory clarity, and a new wave of institutional trust that's setting the stage for a potentially game-changing era. Stick around, because you won't want to miss a single second of this. Don't forget to smash that like button, subscribe for all the latest, and ring that notification bell so you're always in the know. A prominent family's bold crypto venture. The Trump family is making significant waves in the cryptocurrency landscape, with a strategic move that could redefine institutional exposure to digital assets. This development signals a potential shift in how high-profile families and their associated entities engage with the burgeoning crypto market. The focus is on Metaplanet, an entity that appears to be leveraging Bitcoin as a key component of its strategy, aiming to capture institutional interest and capital. This isn't just a casual investment. It's being analyzed as a calculated bet designed to tap into a market that has historically been hesitant to embrace cryptocurrencies. The implications are far-reaching, potentially opening doors for more traditional finance players and influential figures to explore and adopt Bitcoin. Analysts are closely watching how this family's involvement will influence broader market sentiment and regulatory perceptions. The move by the Trump family through Metaplanet could be a critical indicator of how mainstream acceptance and institutional adoption are evolving. It raises questions about the future of digital assets as a legitimate investment class, especially when backed by such prominent names. The strategy appears to be centered on securing institutional exposure, which is a critical hurdle for Bitcoin's continued growth and integration into the global financial system. This expansion by a well-known family into the crypto sphere is more than just a financial transaction. It's a statement about the perceived stability and future potential of Bitcoin as a store of value and an investment vehicle. The market will be keenly observing the performance of Metaplanet's Bitcoin holdings and the broader impact of this high-profile endorsement on institutional investor behavior. But is this strategic play enough to offset a historically challenging month for Bitcoin? We'll dive into how gold is performing as Bitcoin faces its September curse. Bitcoin's September slump versus gold's golden comeback. As September dawns, Bitcoin finds itself staring down its most historically challenging month. For over a decade, this period has been a notorious downturn for BTC, a time when gains often evaporate and optimism can quickly sour. This year appears to be no different, with Bitcoin experiencing a dip to around $107,270 before stabilizing near $110,000. While some attribute this to low-liquidity holiday trading, the statistical evidence is stark. Bitcoin's average September return over the last 12 years is a negative 3.5%. Even during periods of strong market growth, September has consistently acted as a drag on Bitcoin's performance. The current market conditions do little to inspire confidence, with significant outflows from Bitcoin ETFs recorded in August, marking the second worst month on record for these investment vehicles. Institutional buying, which was a major driver of the bull run, has decelerated to its slowest pace since April, leading traders to openly discuss the possibility of Bitcoin retesting the crucial $100,000 support level, with some even predicting a drop to $94,000. The psychological impact of breaking below the six-figure mark could be substantial, significantly denting market sentiment. Meanwhile, gold is experiencing a remarkable resurgence. Spot gold prices have climbed to within striking distance of their April all-time high, reaching $3,489 per ounce. September is historically gold's second strongest month, and the current macroeconomic climate, marked by inflation concerns, uncertainty surrounding Federal Reserve policy, and escalating trade war tensions, is providing a strong tailwind for the precious metal. Notorious Bitcoin skeptic Peter Schiff seized the opportunity to declare gold's breakout very bearish for Bitcoin, highlighting the stark contrast between the two assets. While Schiff's bias is evident, the data suggests gold is indeed rising as Bitcoin falters. If Bitcoin truly held the mantle of digital gold securely, it should be tracking gold's upward trajectory. Instead, this correlation appears to be breaking down. The broader economic landscape adds further complexity. The U.S. is navigating trade tariff disputes, and the Federal Reserve's upcoming September 17 meeting is widely expected to signal the first rate cut of the cycle. Theoretically, increased liquidity should benefit Bitcoin, but if investor sentiment is shaken and capital is flowing into gold, the crypto market might miss out on the initial boost. There's a contrarian view, however, which posits that seasonality, while real, is not a definitive predictor of outcomes. Despite Bitcoin's historically poor September performance, some analysts argue that increased institutional adoption has fundamentally altered the market's dynamics, potentially blunting the impact of the so-called September curse. Yet, the path of least resistance in the immediate term appears to be downward. Bitcoin bulls desperately need a narrative shift to prevent a slide towards the critical $100,000 level. This September is shaping up as a battle of narratives, gold reasserting its position as a timeless store of value, and Bitcoin struggling to maintain its digital gold reputation. For now, the tangible asset is outperforming the digital one. However, Bitcoin doesn't need to outperform gold every month. It simply needs to survive September without significant losses. If BTC can hold the six-figure mark, the anticipated liquidity wave from the Fed could pave the way for an October comeback. Failure to do so might give Peter Schiff ammunition for his bearish Bitcoin outlook. Can Bitcoin weather this storm and emerge stronger? Our next story reveals how institutional demand is creating unprecedented supply pressures for Bitcoin. Institutional appetite skyrockets, draining Bitcoin's supply. In a development underscoring the growing institutional embrace of Bitcoin, demand from corporate treasuries, private businesses, and exchange-traded funds, ETFs, is now outstripping the rate at which new Bitcoin is being mined by a staggering margin. Data from River, a Bitcoin financial services firm, reveals that these institutional entities collectively absorbed approximately 1,755 BTC per day on average throughout 2025. This significant influx is further amplified by an additional 1,430 BTC daily being acquired by ETFs and various investment vehicles, alongside governments adding around 39 BTC daily to their reserves. In stark contrast, Bitcoin miners are currently producing only about 450 new BTC per day. This dramatic imbalance between demand and supply has prompted analysts to raise serious concerns about a potential supply shock, especially if this aggressive institutional adoption trend continues unabated. The rapid accumulation of Bitcoin by corporate entities is fundamentally reshaping the cryptocurrency's market dynamics, highlighting the increasing influence of institutional investors. Bitcoin treasury companies alone acquired a substantial 159,107 BTC in the second quarter of 2025, pushing the total holdings by businesses to an impressive 1.3 million BTC. Leading this charge is Michael Saylor's MicroStrategy, which holds a colossal 632,457 BTC in its corporate reserve. According to Bitcoin Treasuries, the sheer speed and volume of MicroStrategy's accumulation have led some market observers to liken its buying strategy to a synthetic halving, effectively reducing the available supply at a pace comparable to the programmed reduction in mining rewards. Despite this aggressive accumulation, MicroStrategy's corporate treasury officer, Shirish Jajodia, has pointed out that the firm's purchasing strategy is designed to minimize short-term price impact. By conducting acquisitions through over-the-counter (OTC) transactions executed off major exchanges, MicroStrategy avoids directly influencing spot markets or exacerbating price volatility. Jajodia emphasized that, with Bitcoin's daily trading volume exceeding $50 billion, even substantial purchases spread over several days would not significantly alter market dynamics. The broader market is also witnessing a tightening of available Bitcoin supply. Data from CryptoQuant indicates that Bitcoin reserves held on trading platforms have plummeted to multi-year lows. This trend signifies a growing preference among investors, including institutions, to move their holdings into cold storage rather than keeping them readily accessible on exchanges for immediate sale. A declining exchange reserve is a strong indicator of a contracting circulating supply, which, if sustained alongside robust demand, could exert considerable upward pressure on Bitcoin's price in the long term. Analysts are divided on the ultimate implications of this supply-demand imbalance. Some foresee it as a potent bullish catalyst, particularly if adoption continues to accelerate and liquidity constraints become more pronounced. However, the risk of short-term volatility persists, especially in response to shifting market conditions or macroeconomic pressures. Bitcoin's recent price pullback, which saw it dip below key support levels, serves as a reminder of the potential for near-term corrections, even as the long-term fundamental outlook strengthens. The current environment suggests that Bitcoin's scarcity is becoming an increasingly powerful narrative, potentially driving significant price appreciation as institutional adoption accelerates. This intense demand is creating scarcity, but what other factors are propelling Bitcoin to new heights? We'll explore the confluence of regulations, scarcity, and trust that's ushering in a new era for Bitcoin. Bitcoin's monumental surge. Scarcity, regulation, and institutional trust ignite new era. Bitcoin has achieved a historic milestone, soaring past the $109,000 mark for the first time in over a year, propelled by a powerful combination of macroeconomic shifts and a surge in institutional adoption. This remarkable rally in late Q3 2025 marks a significant turnaround from its struggles to break the $60,000 barrier in early 2024, with daily trading volumes now reaching unprecedented highs. Analysts attribute this explosive growth to a confluence of factors, including growing expectations of Federal Reserve easing, a sharp decline in short-term interest rates, and a broader capital rotation into high-risk, high-reward assets. The digital assets ascent is intrinsically linked to the April 2024 halving event, which slashed miner rewards by 50%, thereby tightening the supply of new Bitcoin entering the market. Historically, halvings have acted as significant catalysts for price appreciation, and current market dynamics suggest that scarcity is increasingly becoming a dominant pricing factor. Institutional investors, ranging from pension funds to sovereign wealth firms, have significantly ramped up their Bitcoin holdings, providing a robust foundation for the ongoing bullish momentum. This increased institutional confidence is further bolstered by a clearer regulatory landscape in key jurisdictions. The U.S. Securities and Exchange Commission's (SEC) approval of a suite of Bitcoin futures-based ETFs marked a pivotal moment, integrating the digital asset more deeply into mainstream financial infrastructure. These ETFs have attracted billions in inflows since their launch in early June 2025, dramatically increasing exchange-traded volume by over 300% compared to the previous year. On the macroeconomic front, falling U.S. inflation rates, dipping below 2.5%, have fueled speculation that the Federal Reserve will implement more aggressive interest rate cuts before the year concludes. This environment has encouraged a wider shift in asset allocation towards equities and digital assets, both of which are expected to outperform in a low-yield economic climate. Furthermore, central banks across Asia and Europe are actively exploring the integration of Bitcoin into their broader digital currency strategies, lending further legitimacy to the asset class. Despite the strong upward trajectory, market participants remain aware of Bitcoin's inherent volatility. The rapid price increase to $109,000 presents a potential for profit-taking and short-term corrections, especially if macroeconomic indicators suggest a resurgence in inflation or if the Fed adopts a more hawkish stance. Nevertheless, underlying structural trends, including the widespread adoption of blockchain technology and the increasing integration of digital assets into traditional financial systems, suggest that Bitcoin is well-positioned to maintain its elevated price levels in the near to medium term. The surge has also revitalized interest in Bitcoin mining operations, with energy providers and infrastructure firms reporting heightened demand for specialized hardware and electricity contracts. New mining facilities are being established in regions with access to low-cost renewable energy, potentially rebalancing the global mining network and impacting Bitcoin's steadily increasing hash rate. As the market continues its evolution, close attention is being paid to both regulatory developments and technological advancements, such as upcoming network upgrades aimed at enhancing scalability and reducing transaction costs, which could further solidify Bitcoin's role as a global digital store of value. Bitcoin's rally is undeniable, but what's next for this booming market? We'll wrap up with a quick recap of all today's top stories and our call to action. And that's a wrap on today's market movers. We saw the Trump family make a big crypto play, Bitcoin facing its September slump against gold's shine, institutional demand creating serious supply concerns, and Bitcoin breaking $109,000 on a wave of scarcity and trust. Don't miss out on any of these critical updates. Make sure you're subscribed to Bitcoin Bulletin, hit that notification bell, leave a comment with your thoughts, and follow us on all social platforms for more exclusive content.